Welcome to Yahoo Finance Live. I'm Akiko Fujita along with Shauna Smith. Let's get you up to speed on the market action with just 1 hour left to go in the trading day. We're seeing a bit of a reversal here with all three majors in the red right now. The Dow now on track to snap that historic 13-day straight day of gains, winning streak there. It is down about 220 points right now. The S&P 500 down 27, the NASDAQ down 83. A number of things weighing on the market. Of course, investors still digesting the Fed's decision from yesterday. We also had some disappointing earnings coming through. Let's take a look at bond yields because we have seen that move higher. Remember, we saw a bit of a reversal yesterday on the back of Fed Chair Jay Powell's press conference. We are seeing the 10-year yield up right now at just over 4%. Well, Shauna, a number of things to really walk through today in terms of the data that we got through. Markets down despite a stronger than expected GDP print coming through. Yeah, and it's pretty remarkable. We heard from Fed Chair Jay Powell yesterday just about how the Fed is looking at the economy, the parts of the economy that have been extremely resilient. One of those is the consumer continuing to spend despite all the macroeconomic pressures. And that was reflected in that GDP print that we got this morning, coming in better than expected, accelerating 2.4% rate. Consumer spending increasing at a 1.6% pace. And that really just points to the fact that consumers are willing to spend, at least right now. Some of that was also reflected in the earnings results that we got this morning. McDonald's being one of those companies that has been able to weather this uncertain period better than some of its peers, at least up until this point. The company did beat expectations, and this quarter was helped by higher prices, higher traffic. More people have been trading down, so they've been coming to McDonald's. But the outlook, though, did give some caution there, Kiko, when they were talking about the fact that consumers do have less to spend right now when we look out to the remainder of the year. And what that means for consumer-facing stocks, clearly it could be a tough couple of months. Yeah, it's an interesting contrast when you look at where the GDP print came in. Consumers still spending, but they are being selective in what they're spending. And you point to what we heard from McDonald's. The thing that stood out to me, CEO Chris Kempczinski saying the chain is performing well with consumers who make less than $100,000, and then those who make under $45,000. So we are seeing, you could argue, a bit of a trade down or really just a value play. McDonald's being able to compete on that front, but that does point to the caution that we're seeing in the consumers. And while we're focused on McDonald's today, we heard from some of the other consumer-facing brands this week, Coca-Cola saying they're not going to be raising prices. We heard Unilever saying that the consumer's increasingly turning cautious. So while we are seeing those consumer spending numbers stronger than expected, it does point to a bit of caution that's continuing to percolate through. It does, and it's also very interesting when we also take a look at what consumers are focused on. Not so much products right now, they're more focused on experiences, and that was reflected in the numbers that we got this morning from Royal Caribbean. Extremely strong quarter there from the company. The CEO, Jason Liberty, saying, quote, demand is exceptionally strong. We're looking at a huge move to the upside for shares at the highest level that we've seen since pre-pandemic. So when consumers are spending, many are going out and spending on experiences. We know the cruise line industry has had a tough time recovering, but demand has now been very strong for several months in a row. When you take a look at that outlook, that better than expected full year profit forecast that we got from Royal Caribbean, they see, at least it seems like they have confidence that the consumers will continue to spend on experiences. Well, and that aligns with what we heard from Southwest too, that consumers are increasingly willing to spend on these experiences. That stock, though, down. Partly, I would argue that on the back of the company being able to manage some of that demand, with CEO Bob Jordan saying that they're still working to align the network, fleet plans, and staffing to better reflect the current business environment to be able to meet that demand. So interesting storylines coming through here, really giving us a good pulse of the consumer. Now, the U.S. economy, as we noted, grew at a faster pace than expected in the second quarter, adding to signs the threat of a recession has faded, at least in the near term. This coming on top of what Jerome Powell said on Wednesday. The central bank staff no longer forecasts a U.S. recession. Joining us now is David Wagner, Aptus Capital Advisors portfolio manager. David, what's your read on where the consumer is when you consider what we've heard from some of these earnings calls and then what we got from the Fed yesterday.
Yeah, Kiko, you're exactly right. You're seeing it on the macro side, but also the fundamental side. Just looking at a lot of the stocks you just mentioned right there. But let's look at some of the macro data. And one thing I'm really focusing on is the U.S. household net wealth. All right, I have a saying that I always tell people that the market in the short term tends to focus on the rate of change, but over longer periods of time, it tends to focus on the absolute value. And if you look at the 12-month rolling year-over-year U.S. household net wealth, it's actually gone into negative territory. And whenever that has happened, it's actually coincided with some type of recession. But if you look at the absolute level, what I would say the market focuses on over longer periods of time, the U.S. consumer remains very, very strong. If you look at the net wealth, relative to, say, pre-COVID, they're about 34% more wealthier than where they were Q1 2020. If you look over on a longer period of time, relative to maybe the last 10 years, the U.S. consumer is 120% more wealthy than where they were. So right now, the consumer remains very strong. Their propensity to spend is still there, and it's definitely not stopping this economy right now.
So, David, what does that tell us just then about the odds of a recession down the line? If, in fact, the Fed is not done hiking, if we do see another raise here before year end, where does that stand just in terms of the likelihood of a downturn and how extensive that could be?
Well, the can has definitely been kicked down the road. If you looked at, majority of the economists entering into this year, almost 95% of them said that the U.S. economy was going to go into a recession in 2023. They actually just redid that statistic just last week. And now only 58% of people actually see the U.S. heading into some type of recession. So it's definitely the consumer that's, definitely guiding this market through this type of scenario. And at Aptus, one thing I think we do well is we write very thematic papers. And one thing I was going to write on the consumers, it's going back to Ayn Rand's book, Atlas Shrugged. Came out like 1960. But in a way, right now, the consumer is Atlas, holding up the world right now because obviously GDP numbers came out this morning. The consumer accounts for now 72% of GDP. So they continue to carry this market forward. And you know what? A lot of investors right now are waiting to see if Atlas, i.e. the consumer, if they're going to shrug.
There's the question of whether another rate hike can be coming, but also the question of how long we remain at these levels in terms of interest rates in order to make sure that inflation doesn't re-accelerate. How do you view that right now? Are you already looking at the potential for maybe a cut at the end of the year next year, or you think we're kind of at this level for a while?
Well, there's definitely a difference in what the Fed has been saying 6 weeks ago and then again yesterday relative to what the market is really saying. I mean, the market's saying that, hey, you know what? We don't believe any more rate hikes this year. In fact, we think some type of rate cut next year. Obviously, the Fed, Jerome Powell, is saying something very different. I think what the Fed has done really well lately is a consistency and transparency of their messaging to the market right now on what they're going to be doing. It's unfortunate that the market doesn't believe that, but the number one thing that Jerome Powell doesn't want to do right now is go back to what happened back in the 1970s. Go back to that stop and go mentality from a monetary policy standpoint. And that's what we're actually seeing across the entire globe right now, that a lot of these different countries are actually having to go back to raising rates to fight inflation because it's really sparked back.
And the other obvious data points that we've been getting over the last several weeks has been earnings. We're starting to getting a look at some of the tech giants here this week. Meta was the latest to report last night, better than expected results on both the top and bottom line. Also, their guidance was very strong. From the earnings results that we've gotten across the board so far, the beats have been very strong. Over 80% of the companies have beat the street's expectations. Is that enough for the market to keep that momentum to the upside?
Well, it's like the market's trying to take the playbook of what's happened the last 5 quarters. Obviously, earnings per share, EPS, has been very insulated, especially since February. Every single sector in the S&P 500 since February has seen an increase in EPS right now. And what we know is that the market tends to follow that statistic very closely. As earnings per share revisions go higher, really so does the market right now. But one thing I'm really focusing on, because, Shauna, I really agree with you. Yeah, 80% of the companies have beat on the top line, like 64% of the companies have beaten on the bottom line. Mm-hmm. But look at the market's reaction to those beats, right? Because the average beat on a quarterly basis is like 73%. You mentioned 80%. Well, the following day, the performance of those securities reporting the following day, on average, they're down about 25 basis points, when historically they are about beating the market by, say, 1.5%. So from a sentiment perspective, what is that telling me? It's, telling me maybe all this good information, all this guidance talk, all this management commentary that we're seeing is already priced into this market at a 20.5 times forward earnings.
Or maybe the bar's so low that even if you've got the beat, it really is about the guidance, right? I mean, if you think about where the stock has been moving, it has been on weaker guidance. We have seen, you look at a name like Snap, really plummet in a big way. Where do you sort of then go from there in terms of your investment thesis?
So,
if the expectation is that there is some form of recession waiting on the other end.
Yeah, I'm very cautious right now. If you just look at the macro perspective, and I'm going to kind of go, I'm a wild card, so I'm going to kind of just go away from maybe that comment, because I think the one thing that's not being said in this market right now is that the market doesn't believe in the right tail risk of interest rates occurring. And what do I mean by that? That the market does not believe that rates are going to be higher for longer. And what I always tell people is that you have to follow the tape of the market. And if you go back to March 9th when SIVB collapsed, a lot of people forget that the market was flat on the year. And ever since that date, the market is now up 19%. So that date is telling me something. It's telling me that right tail risk of interest rates is off the table. But then Akiko, look was one of the things you said at the beginning of the show. Look at the 2-year, look at the 10-year. The 2 years back up to 5%. The 10 years back to 4% right now. That's the exact same interest rate that the market was pricing back on those March 9th levels. And yet the valuation expansion has been the only contributor to the S&P 500's performance during that period. So I think my biggest worry on what the Fed is saying right now and what we're seeing with a lot of these earnings, the valuation, is what happens if that right tail interest rate risk is reintroduced to the market right now.
All right, well, David, let's talk about, because you brought some specific picks, some advice here for investors. You also have two names that you're saying that investors should avoid right now. So let's get into that. David Wagner of Aptus Capital Advisors, portfolio manager. David, let's start with your first pick, and that's a home builder play. Clearly, we have seen the home builders get some momentum as some of the inventory constraints within the housing market. Potential buyers are left with new construction almost as the only option right now. Your pick is Lennar. Why does that stand out in the group?
Yeah, it's actually more of a whole macro play for the entire group. I think when I started looking at these stocks back in May, I was definitely a contrarian. But, Shauna, you hit the nail on the head from a macro perspective. That resale market that you're seeing out there right now is absolutely, there's nothing there. I think the year-over-year number on the resale inventory was down like 21%. So that allows these home builders to start taking market share. But not only that, look what Lennar was doing. They were kind of the alpha architect of this mortgage rate buy-down system, which is definitely kind of an industry standard right now. We know that the 30-year mortgage rates are closer to, say, 7%, but they're offering these buyers 4.5%, 5% right now. So how can people turn that down? So what they're doing is they're basically creating a competitive moat around the entire industry that was once considered to be, very commoditized in a way. So even at valuations of 1.8 times book, I'm still very bullish here because I just see the runway for growth continuing for quite some time.
Another stock you like is United Healthcare. Walk me through your thesis there.
Yeah, with home builders, there's more macro, and I'm a fundamental investor at heart. And this is straight valuation here right now. If you actually look at UNH last year, they're trading about a 30% premium to the market. Right now, they're trading at a 10% discount. Basically, levels that we're seeing during a period of Medicare for all back in 2013, 2014. So it's one of the cheapest times I've ever seen this stock on a relative basis. And it's for one of the highest quality stocks I've seen in the S&P 500, and obviously number one in the healthcare industry for me. I mean, look what the management team did to kind of diversify their book out of their insurance business into Optum. And now I think that they're starting to look for that third leg of growth that could come through some type of AI beneficiary. I know that's a buzzword, and we don't know when that's going to play on out. But I do think in longer term, they have the abilities to utilize that AI, that data, to decrease costs and increase volume. So you couple that alongside a valuation, what I think should be trading at maybe a 20% premium instead of a 10% discount, I think this stock's a no-brainer.
Well, David, on the flip side, some of the plays that you're saying investors should avoid right now at all costs, one of that is a sector play. You're warning against utilities, a tough environment right now given those higher rates.
Yeah, Sean, I saw a statistic that actually really surprised me today, that right now there's only 15 stocks in the S&P 500 that have a yield higher than the 2-year treasury. And only one of them is actually a utility. And we've known historically that utilities tend to be very defensive in nature. They tend to be that yield play. But now there's a competition for income now with treasury. So there's no benefit in my mind for holding utilities for a lot of these dividend or retiree investors, because you get a lower dividend yield and you get a valuation that's exorbitantly high relative to the S&P 500. It's almost like it's the most expensive house in the most expensive neighborhood. So I just don't see it showing the exact defensive characteristics that it has historically.
And commercial real estate.
That's a tough place to be.
I mean, we were talking about new homes, right? We're talking on the other spectrum of it. There's been so many doom and gloom scenarios there. What is your expectation on what's likely to come, especially when some of that debt is due?
Yeah, I mean, you're seeing a lot of default news basically on a daily basis. But, what I try to do is I take the macro data, but look at it from what is the stocks really pricing in right now. And I think there could be more degradation in the valuation of these securities because right now there's not a long runway for growth for these companies. And then they have a weighted average cost of capital headwind that's really moving forward. One, on the debt side, because debt has become so expensive to a point where the debt is more expensive than the cap rates on a lot of these properties that they're trying to buy. So that's a negative IR type of project. So they're not going to take these projects on. So you're not going to have growth from that. But you could also look at it from a valuation perspective. Yes, valuations have come down, but that means when they need to issue equity because debt is so expensive, they're not going to be able to do it from a creative manner because it's really weird. Within REITs especially, or commercial real estate, you actually want a higher valuation, not a cheaper valuation, because you want to use that as currency to issue equity out there to get basically cheaper weighted average cost of capital. So right now, I just see the sentiment in the space just being too heavy against it. So I'm definitely staying away here.
Yeah, tough to find somebody who's positive on commercial real estate right now.
Maybe that's a problem.
David Wagner, Aptus Capital Advisors Portfolio Manager. Good to talk to you.
Thanks for having me.
All right, let's do a check of the market sponsored by Tasty Trade. About 45 minutes to go in the trading day. The Dow now off just around 156 points, on track to snap that 13-day winning streak for the Dow. The S&P off by about 1/3% here, and the NASDAQ off about 0.2%. Taking a look at the VIX, the fear gauge index moving to the upside right around 1438. All right, let's take a closer look here at the markets, what we could expect here for the remainder of the year. Jared Blickery is putting this, I believe, into historical context for us here. Jared, so take it away.
Yes, so much for this Dow streak. Well, it looks like we're not going to get 14, but I do want to show everybody what's happened here. It was a nice streak. Here's the month view in candlesticks, and here's that big red candle right here. That, by the way, is a bearish engulfing, and we'll have to see if anything what the close is tomorrow relative to it, but sometimes those do put in tops. Also taking a look at the, what are we looking at? Here's the NASDAQ composite, bigger red candle there, S&P 500, similar situation. But speaking of the S&P 500, we are now about to be up 5 months in a row as of July, and I looked at all the historical terms years when the S&P 500 was up over 10% at this stage in the year. That's as of July. Only 1 year finished with negative performance in August through December. That was 1987. Huge crash that year. So pretty bullish, 95% positive overall with an average return of 4.8%. When you look at the NASDAQ, we got a bunch more red years, yes. Still looking at almost 70% positive, about 6% average here. And then going back to the Dow, I like the Dow gaining 9 straight days. That gives you a nice big sample size of 32, and we can see this has a 78% historical win rate. And you put it all together, the Dow stats, the NASDAQ, the S&P stats, things are looking pretty bullish, at least from a tailwinds perspective, through the end of the year.
All right, Joe Blickery, thanks so much for breaking that down for us. Well, coming up next, we have a lot more to go here on Yahoo Finance. We will be breaking down much more. We'll be right back.
Welcome back. This is Yahoo Finance. I'm Julie Hyman, dropping in to take a look here at what's happening in the industrial space, specifically agriculture. Farm equipment maker AGCO reporting earnings ahead of the open, and those results did beat on the top and bottom lines. The company also raised its full-year guidance. Joining me now to talk more about it, AGCO CEO Eric Hansotia. Eric, thank you so much for being here. Really appreciate it. So you guys had these strong results. You raised your forecast. I wanted to sort of start big picture here because as you guys talked about on the conference call, about a quarter to a third of your business is from sort of the smaller side of the business, smaller farmers, for example. And there, the results were not necessarily strong, particularly in tractors. So kind of what are you seeing demand like?
The market has two major categories, small ag and large ag. During COVID, a lot of folks bought small ag because they were kind of trapped in their home and they saw projects out their window, so they pulled in demand to work on those projects. So we saw a lot of demand over the last few years. That's cooled off a little bit because there's a bit of pull ahead and it's a little more interest rate sensitive. On the large ag side of the business, though, going very strong. There's not enough grain in the world. Farmers need more productivity. Our products are loaded with technology and artificial intelligence, and they're very hungry for these products. So that's going very strong.
And that is your fence side of the business, the sort of also higher engineering, higher tech, bigger, literally bigger also part of the business. You talked about, even though you raised your forecast, that in the second half of the year, you're going to have some pressures. And that seems to be what's putting a little bit of pressure on the stock today. And you explained a little bit about what's going on the call as well, but talk to investors and potential investors here about some of those pressures and how long lasting they might be.
Well, I would probably reframe it. They're not really pressures. They're just what we had the best quarter in the history of the company this quarter. I mean, it was a blowout quarter. Now, going forward, we're continuing on the pace that we've been the last few years. We're continuing to invest in more engineering. I've raised engineering 20% every year since I've been leading the company. It's all to fuel these technology-rich projects on our products to add more value to farmers and in turn add more value to investors. Our margins have steadily been going up. We've been gaining market share. We've been gaining net promoter score with our farmers. And so there's continued extra investment in engineering in the back half of the year. That was planned. We expect some of the areas of the business to be a little stronger. So there's a mixed difference. So in Brazil, for example, there's a government incentive program that's going to likely incent the purchase of more small tractors. That just means we're going to sell more of those, and there's a little bit less margin on those tractors. So it's not like any issues are headed our way. It's just the plan is going according to plan, and that's the results we're expecting.
Eric, as you might imagine, we are very focused on what's happening on the inflation front. What's happening for you guys input cost-wise? How much are you seeing that moderate? And then on the flip side, what are your pricing plans from here? Do you plan to raise prices between now and the end of the year?
We have actually a pretty good environment relative to supply, both on supply volume. It's gotten way better. A year ago, we were having 7 or 8 issues per machine. Now we're down to 1 or so. Our rescheduling of our assembly lines issues has cut in half. So volume of components coming in is way better. The inflation of our component coming in to us is coming way down. We're seeing a lot of relief. I mean, the freight cost is like down 70% or something like that from the peak. So we're seeing a lot of that moderate. That's allowing our supply chain to have a more predictable build plan, build to order, and do exactly what we intended to do this year is build a customer order. We didn't want to have this big surge at the end of the year to catch up. On the pricing side, we've put a lot of price into the market over the last several years. We expect that to stick, and we expect to put a little more into the market, but not at the same high rates as last year. And that just goes along with the general fact that inflation is coming down. So we still see pricing power, but it'll be more like trending towards normal historically than what we've had over the last couple of years.
And then, Eric, finally, I think most people don't realize how sort of engineering forward and technological forward the tractors are and combines are and harvesters are. So what are your customers most excited about in terms of new innovation and development here?
The big thing right now is automating features. Essentially what that means is we're taking a given task that the farmer does, and through sensors, artificial intelligence, onboard compute, having that being done automatically by the machine. We can, like one of our sensors called Smart Firmer on a planter, 24-row planter, it'll take 780,000 measurements a minute and automatically optimize the performance of that planter in many ways. This way, not only does the farmer get a whole lot better performance out of their machine, increasing yields, they do a better job of using their inputs, reducing their costs, and it's a much easier machine to operate so that they can manage with skilled labor, the lack of skilled labor. So that's the big thing. Those are all stepping stones on the way to full autonomy, pulling the operator right out of the cab, where we've shown in our tech field days just a month ago or so. And then the other one is clean energy, the conversion to either battery power or other sources to help with this productivity while being more sustainable at the same time.
Yeah, it's really interesting stuff. We talk about that in cars all the time, but it's happening in the field as well. Eric Hansotia, thank you so much. Really appreciate it. CEO of AGCO, thank you.
Thank you.
Shauna?
U.S. regulators set forth sweeping proposals to protect against future blowups in the banking sector following the industry turmoil earlier this year. Yahoo Finance's Jennifer Schomburger is here with a breakdown on those proposed changes. Jen.
Shauna, the Federal Reserve, the Comptroller of the Currency, and the FDIC all proposing that banks raise capital levels to protect against future bank failures. The new long-awaited rules, known as Basel III, were mandated internationally and also are taking into account changes in response to Silicon Valley Bank and other regional bank failures. Regulators are proposing increasing capital requirements by 16% in aggregate, breaking that down by bank size. Globally systemic banks like JP Morgan and Bank of America would see capital increase by 19%. Banks with assets of $250 billion or more would see capital increase by 10%. And banks with assets of between $100 billion and $250 billion would see capital increase by 5%. Regulators also propose changes in how these banks assess risks and widen the scope of new rules to include banks with as little as $100 billion in assets. Fed Chair Jay Powell supported putting this new proposal out for comment, but said regulators need to weigh the costs. Powell noted the proposal is tougher than international standards and could lead to a drop in liquidity for capital markets and push activities into the shadow banking system. Powell saying, quote, while there could be benefits of still higher capital, as always, we must consider the potential costs. This is a difficult balance to strike, and striking it will require public input and thoughtful deliberation. Now, two Fed governors, Chris Waller and Michelle Bowman, opposed this and voted against the proposal. The banking industry also staunchly opposed to this. Back to you.
Jennifer Schomburger with the very latest on that front. Thanks so much for that. Well, coming up, the Fed leaving the door open for another rate hike this year. We're going to discuss the futures of the Fed with Nick Timmeros of the Wall Street Journal on the other side. We'll be right back.
Fed raising rates a 1/4 percentage point, bringing the federal funds rate to a 22-year high. And Fed Chair Jerome Powell leaving the door open to another rate increase this year. Joining us now is Nick Timmeros, the Wall Street Journal chief economics correspondent. Nick, great to have you here. You were in the room with Fed Chair Jerome Powell yesterday. Got a question, too. I'm curious to get your perspective on the messaging from Powell yesterday, because he was asked time and time again about how the Fed is looking at future rate hikes. And he did say that the Fed can afford to be patient, but also left the door open to further rate hikes. Is that what how do you think he messaged that to the markets, and whether or not it was clearly received?
Well, I think he was pretty clear that he wants to keep all of his options on the table. And so that's what he did yesterday. Of course, markets think the Fed is done raising interest rates, as do many, but not all of the Fed watchers on Wall Street. And Powell, I don't think he said anything to explicitly validate those views, in part because it's probably too soon. We've only had one really good CPI report. By September, maybe we'll have two more. And so it would be easier then to say, well, the last three inflation numbers have been much better than before. But he also, I don't think, sounded like somebody who strongly disagrees with the idea that the July rate increase might be the last one. The Fed says it's data dependent, and so the next batch of data will be important. And then I think there's another question of whether that rate increase, if there's going to be one, has to happen in September, or whether you could do it in November. Powell again tried to keep all the options on the table, but I didn't hear anything that would suggest a lot of urgency to raise rates in September. If you think you're going to have to raise rates, but you want to be a little patient, as he said, then you could do that at the meeting in the fall.
Nick, there's been a lot made of the divisions that we're starting to see form within the FOMC. I think the Fed chair yesterday said there's a range of views on the committee, and you've sort of broken it up to, I think, three different camps. You were talking about sort of a team transitory optimist. There's the hawks on the other end. Do you get the sense that with the latest data coming through, that divide is starting to narrow on the committee?
It's a good question. I don't think we really know yet, because we haven't heard from a lot of the committee members since the June CPI came out in the middle of July. So we'll tell. I mean, these folks usually hit the airwaves after the meeting ends, next week. So we'll hear from more Reserve Bank presidents. Right now, you have at least a loud minority that have been pushing for another rate increase, maybe in September. But I don't want to overstate how large that group is. We're talking about a couple people, maybe more, who will speak up. You had one Fed president, Raphael Bostic, before the meeting saying he didn't think they needed to raise rates anymore this year. I think that leaves kind of a larger undecided center, and that center group, could probably lean towards another increase in November or December if the data warrants it. I think the big unanswered question for now is how the Fed would react if the data came in a little bit better than anticipated, both on economic activity, but also on inflation. Those sort of cut against each other. If inflation's getting better, maybe you don't have to do as much. But if the economy's not slowing down as much as you thought, maybe you do. So that was what I asked Powell about yesterday. He didn't really answer the question that clearly, but he did seem to suggest maybe inflation is first among equals in determining the next move. So we'll see.
Well, Nick, what do you think the basis then is for a pause? We were talking to former Atlanta Fed President Dennis Lockhart yesterday, and he was talking about the fact about whether or not the Fed is going to focus on outcomes or whether it's going to focus on outlooks and what would be sufficient for that pause. How are you thinking about that?
Well, it's interesting because it's not as if, at least to my ear, we're arguing about too much more than another 1/4 point. Maybe there are a couple people who want to do 50 basis points more. So when you get to the end, or when you think that you're at the end of a tightening cycle, it's natural for there to be more disagreement. But the stakes aren't, I wouldn't overstate the stakes here. We're talking about maybe one more increase, maybe two more increases, maybe no more increases. I think the difficulty is probably going to come later. And that's when you're holding interest rates and you're seeing more weakness in the economy, and or you're seeing more of a slowdown. And I was a little bit surprised, how much of the discussion yesterday Powell had about the strategy and the tactics around cutting interest rates. He had sort of avoided talking about cutting rates before. That was, of course, when the market was always moving up expectations of when the cuts might happen. Now that the cuts are mostly priced out for this year, maybe it's easier to have that conversation. Because at some point, if you do care about inflation adjusted or real interest rates, and you're getting inflation to come down, then, and you keep raising nominal rates, or you just hold nominal rates steady, you're going to have real rates rising. And so then the question, I think, is going to be more difficult. What kind of evidence do you need? Do you need 3 months or 6 months of 2% or 2.5% annualized inflation before you start cutting? Are you cutting with the economy in a pretty good growth environment, or have things really slowed down a lot? We don't really know what their reaction function is going to be around cuts. And I'm not sure that they do either, because this isn't, a high inflation environment isn't something that the FOMC's had to deal with for a long time.
Yeah, a lot of economic data is still to parse through between now and September. And of course, the Jackson Hole Symposium sandwiched right in the middle. Nick, always appreciate you being on the show. Nick Timrose, the Wall Street Journal Chief Economics Correspondent. Let's do a check of the market sponsored by Tasty Trade. We are seeing the Dow now near the session lows. That is down 244 points right now. The S&P 500 down 27 and the Nasdaq down 70 points with just under half an hour left to go in the trading session. Well, coming up, Mark Zuckerberg's year of efficiency showing some signs of paying off. We're speaking to Meta's CFO, Susan Li, after this short break. Shares of Meta making big moves on upbeat earnings results today. The company beating the street's expectations on the top and bottom line. Meta also saw some recovery in the ad space, reporting ad revenue growth of 12% year on year. Mark Zuckerberg's year of efficiency showing some signs of paying off. Let's bring in Meta's Chief Financial Officer, Susan Li. She joins us from headquarters in Menlo Park. Susan, it is great to talk to you today. Really strong quarter here that points to a reacceleration of revenue growth. We're talking about 11% growth year on year, digital ad spend specifically 12% year on year. How much of this is about a meaningful rebound we're seeing in the digital ad space? How much of this do you think is specific to what Meta did?
Hi. Well, first of all, thanks so much, Akiko, for having me on the show. It's really great to be here. As you pointed out, this was a really solid quarter for us across broadly our user and engagement metrics, and certainly the reacceleration in revenue that you were pointing to. I'd say that, there are a couple factors that are driving the reacceleration in Q2 revenue, and that also flow into the guidance range that we gave for Q3. First of all, it's an easier compare, frankly, relative to where we were last year at this time, both in Q2 and Q3, and I'd be remiss not to mention that. Second of all, we are seeing stabilization in the broader macroeconomic landscape. And for us specifically in some of the verticals that we have higher exposure to, like e-commerce, retail, CPG, gaming, et cetera. So that's a place where we're optimistic that we're seeing signs of stabilization. And then more broadly, I think we certainly are seeing the execution that we have worked hard on over the last quarters and years, and the investments we've made in product work across both the core engagement side and the ads monetization side, paired with the GPU investments that we've made, play out in a way that I think we feel really good about in terms of contributing to our long run growth. So those are all factors that I think certainly played into the Q2 results on the revenue side. On the expense side, what I'd say is the year of efficiency, I think, has really set us up to be in a good place from a cost structure perspective going forward. It was a tough year, obviously, with a lot of challenging decisions, but we're certainly in a place where we have a leaner cost structure as we plan ahead. And we're also a faster, nimbler company. A lot of the work that we did was really in service of making sure that we're in a position to build more and ship faster and just deliver better experiences for all of the people who use our products. And the final thing that I'd say was a key theme from this earnings call was the early color that we gave into the 2024 expenses. There are a handful of places where we feel like there are compelling opportunities for us to invest in terms of infrastructure, especially around building out our AI capacity, hiring top-tier technical talent, and of course, our long-term vision in Reality Labs and the metaverse. So those are really the big earnings themes for us this quarter.
Yeah, and I want to get to some of those expenses in Reality Labs in just a bit, but when you look at the family of apps, you really did see significant user growth. The latest app out there, Threads, there's a lot of excitement around it. You made it pretty clear on the call that you're still a long way from monetization. But as you look at how to build out that particular app, how significant a revenue driver do you see Threads being in the future?
We're really so early in the life cycle of Threads. I don't think we're at a point yet where we can talk about monetization. Threads is the new standalone app that we just released earlier this month. We're pleased with its user growth numbers and its retention, certainly for a new standalone app that we have just launched. And we're at a place where our focus is really on making sure that the consumer experience is as good as possible. There's foundational product work we need to do, features that users have asked for that we need to invest in. And then we have a playbook that we have executed many times across our history in terms of growing users, in terms of increasing engagement, stabilizing retention. That's going to be our primary focus for quite a long time to come until we're at a place where we feel like it makes sense to start thinking about monetization of Threads in earnest. You getting some calls, though, from advertisers who are excited, maybe potentially moving away from X and looking at Threads as another opportunity? I mean, I'm certainly excited about Threads. I am glad that advertisers are, but it's very early for us. We are very pleased, though, with a lot of the work that we've seen happen across Reels. That's a place where we've executed that playbook that I talked about across growing the product experience, increasing engagement, and ultimately monetizing in a way that's been really, I think, productive for both the people who use Reels and for advertisers. You mentioned the expenses that are adding up. Operating losses for Reality Labs increased more than 30% year on year. And you've been pretty clear next year you're going to be spending even more. I realize this is a long-term play, but where is that investment going? And ultimately, where do you see the return? Is it more in hardware or more in software? This is a really good question. So Reality Labs is a very broad portfolio for us. It spans a lot of things. I think what most people are familiar with is our VR products, the Quest and Quest 2 devices that we've had out in the market, which have really established themselves, I think, as the leading VR headset experience. We also have the Quest Pro device, which was our first mixed reality product, but we're bringing a much more broadly accessible mixed reality device, the Quest 3, to customers later this year. So that's the VR anchor. Now, as I mentioned, the Quest 3 is actually one of our sort of broader forays into mixed reality, which we think both is going to establish the standard for headsets going forward. It's also going to be an introduction over the longer term to AR devices. And AR is really, I think, the place where our time horizon is longest. It is really about trying to build towards the next computing platform. It's where a lot of the investment is going. We also have work, of course, developing the metaverse and social experiences related to the metaverse, and finally, neural interfaces. To your question on the time horizon for returns, it's really a very long-term time horizon, especially on the AR side. But as Mark talked about yesterday on the call, there's both an expansive product vision and a desire to be part of the shaping and the building of the next computing platform. But at the same time, we recognize that there's also a lot of business value that gets accrued from having a key role in really building the next platform. And that's something that we've learned, being built on other platforms right now. So even though there's very much a strong product vision that's underpinning this, at the same time, it's really built towards unlocking a lot of business value over this time horizon also.
A lot of excitement around artificial intelligence. Meta has talked about the use of AI, especially within advertising for some time. But now there's a lot of excitement around Llama and generative AI. How do you see that technology being applied from a consumer standpoint, from a user standpoint? How do you think the experience shifts as a result of this technology?
Yeah, so we've been investing in AI for a long time, but historically more of the emphasis has been on the core ranking and recommendations work that has powered our feed, our ads, the existing consumer experience and advertiser experience. What we're looking ahead at when we talk about the Gen AI work that we're doing is really around how do we make it easier for people to create better, more individualized content. That's true for both creators and for advertisers. How do we enable people to have conversational experiences with AI that are going to enhance different parts of their experience? And how do we enable businesses to talk to and communicate with consumers more efficiently and more productively than they do today? And we think that across all of those dimensions, there's going to be opportunities for us to build out new product experiences and features for our users and for advertisers that we hope will be really valuable. But that's all very, very early. It's not, for example, a part of our revenue guidance in Q3. It's something that we're really thinking about more in the future.
Finally, Susan, something that both you and Mark touched on very briefly in the call yesterday, which is the tough regulatory environment we're seeing in D.C. right now. Today, we've got Senator Elizabeth Warren as well as Lindsey Graham coming out and calling for a federal agency that essentially cracks down on tech. When you look at the environment right now, to what extent does that tie your hands in terms of acquisitions, in terms of capitalizing on the opportunities? How much does that slow down your vision for expansion, knowing the checks that are now being put in place from a regulatory standpoint?
It's a good question. First of all, on the regulatory side, what I'd say is we've been navigating a challenging regulatory environment for some time now, and we're always focused on working productively with regulators to establish frameworks that help protect people while at the same time not stifling growth or innovation. So that's something that we're very focused on, and we want to make sure that we're engaged with regulators productively. It's a big focus. On the second part of your question, we've got a lot of organic opportunities to invest in. We talked about the investments in AI. That's a place where we're going to be building out a lot of experiences ourselves. Same on the Reality Lab side over a longer time horizon. So while we're always evaluating the broader M&A landscape for potential opportunities for us to expand via acquisition. At the same time, I think we've got plenty of things that we can work on organically that are really compelling investment opportunities for the years ahead.
Meta CFO Susan Li, really great to talk to you today. Appreciate your time.
Thank you so much.
Well, if you're nearing retirement, you're likely facing a number of tough financial decisions, and one may be where to live. Here with a closer look at how you should look at that is Yahoo Finance's Carrie Hannon. And Carrie, I guess, what should people consider when they're potentially thinking about relocating for their retirement?
Yeah, there are so many things to think about. The most important thing is first do a little soul searching. I mean, do you want to live in the city? Do you want to live in the country? Do you want to be exercising a lot, hiking? What are the things that are going to matter to you? So that's sort of an inner soul search. The second piece is a little more nitty gritty. What is the total tax picture? You know, it's not just income taxes. People focus on states that don't have income taxes, but think about your property taxes, the retail taxes. It all comes together. So look at all of that. And the third piece of that right there is looking at medical costs. Healthcare costs are probably going to be one of your biggest ticket items in retirement. And they vary greatly across the country. I mean, it's cheaper in Maryland than in Florida, for example. So it's really important to have an eye on those costs.
Yeah, it feels so daunting to have to go through that checklist in retirement. But how do you pick that city or town?
Yeah, I mean, that's really important because you need to think beyond those little things. Okay, housing, what's the cost of housing? If you can sell where you live now potentially and move to a city or a town that has the cost of living for housing is much lower, you might be able to not have a mortgage at all or pay down some of the debt that you might have had. So you start off with a cleaner slate. You should look at the local economy. Is it vibrant? I find that university towns, college towns are fantastic because if you're looking to work in retirement, this is, even part-time, seasonally, this is a great opportunity. Plus, there's cultural events associated with the school. There's educational opportunities at the university or the college. So and they're usually recession resistant because there's a new class of students every year. Look at those. Check out also, transportation costs. And is there an airport nearby? And then this is one a lot of people really need to be thinking about now, climate change. Okay, you might say, oh, really, Carrie, roll your eyes over this? But what's it going to cost to run that air conditioner? What are your utility bills going to be in Arizona and Florida down the road? Or property insurance if you're in a coastal area?
How bad the flooding's going to be.
Exactly. So you need to pay attention. And my final thing is, for gosh sakes, go and live there for a while. Test it out because you might find it's not just because you love going on vacation there. Okay, there could be some great places we love to vacation. But when you're living there, you might find simple things like you have allergies. You have seasonal allergies somewhere. And if you're not there, or you might find the political leanings of the people in your community are not exactly what you're comfortable with. But when you're there on vacation, you didn't notice that. So if you can rent a place for a while and just really test it out because it's a big, huge leap.
A huge leap and a very, and could be a costly one if you do make that wrong decision. All right, Carrie Hannon, great stuff. Thanks so much.
Thank you.
Well, we are counting down to the closing bell on Wall Street. Stick with us. We'll be right back. Counting down to the closing bell, let's check in on a few trending tickers from today. First up, shares in Meta closing the day higher, up just over 4% after the company topped second quarter earnings estimates, citing a recovery in its digital advertising revenue. CEO Mark Zuckerberg went as far as to say Meta will, quote, pour enough gasoline on the Threads app to grow it. And Kiko, you were talking to CFO as Susan Lee earlier today, earlier in the show about the Threads and the opportunity that she sees there, although she was saying that monetization is not anywhere close, at least too early to be talking about that right now. But when it comes to the outperformance that we are seeing with Meta, the strength there is particularly in the ad market recovery and what they've been able to do with AI. I think it's certainly impressive enough for the street up until this point.
Yeah, and it points to how they've utilized AI to really monetize every one of the platforms they have. Quite the claim there on Threads, but we shall see. Let's take a look at shares of Southwest Airlines falling today after the company saw revenue drop 10% in the second quarter to $683 million. The low-cost carrier expects airfare costs to rise and revenue per available seat mile to fall in the third quarter as much as 7%. And not just that, Shauna, it's also about higher labor costs. Fuel costs slowly starting to creep up again. That outlook, despite the travel demand that we've continued to hear about, a big reason why we've seen the stock down in a big way.
Yeah, and it was in contrast to really what we've heard from so many of the other airlines already this quarter. They talk about that strong demand. Obviously, some of their competitors out there, we can take a look at United, American, clearly more of an exposure there, an exposure in general to the international travel, which has really helped them. But when it comes to Southwest, it's all about the higher costs, all about the fact that they're saying that business travel not back to those pre-pandemic levels. And we saw those concerns reflected in the drop today and really across the board, with Southwest off just about 9%. All right, let's also take a look here at shares of McDonald's closing the day in the green as second quarter earnings results beat Wall Street estimates across the board. Yahoo Finance's Brooke DePalma has been following the report today for us. Joins us now some of those key takeaways, Brooke.
Yeah, well, shares remain largely flat after the call this morning. And in addition to that, the theme really this past quarter was that viral campaign Grimace. But ultimately, they did beat on both the top and bottom line. Same-store's beat were largely driven by that Grimace campaign, in addition to other marketing promotions that happened overseas. But executives did speak more on the call about their expectations that top-line growth is expected to moderate as they expect inflationary margin pressures to continue later on this year. They also do expect consumer trade down. They say that consumers making under $100,000 are trading into McDonald's. They also noted that incomes of $45,000 and less are looking to order smaller sizes. And on that call, CEO Chris Kim Chency said that value positioning in the market puts McDonald's in a good spot to gain share. Take a listen.
We're winning on value. So the programs that we have in place are working and delivering for us, and it shows up not just in our overall performance, the fact that we're driving both check and we're driving guest counts, but it shows in our consumer sentiment scores, where we are maintaining our leadership in affordability and in value for money.
And so McDonald's really still having pricing power here. They're still seeing an influx of customers go to their stores, and no plans to bring back that dollar menu because of that. They said that their value advantage, as you heard there, is still working, and they aim to keep it as is. We'll continue to watch whether or not McDonald's continues to gain customer traffic in the second half of this year.
All right, we will be watching for that. Brooke DePalma, thanks so much. The closing bell on Wall Street ringing just about a minute ago, and taking a look at where things ended the day. This market check sponsored by Tasty Trade. You're looking at the Dow closing right around the lows of the day, off 238 points, snapping that 13-day winning streak. The S&P and the NASDAQ also closing to the downside, with the S&P off just about 0.6%. Intel second quarter earnings releasing any minute here with a closer look on what we can expect and give us his immediate reaction once they cross the wires. We want to bring in Matt Bryson, Wedbush Securities Senior Vice President of Equity Research. It's great to see you here. So we are waiting these results right now, but what's the key thing that you're looking for in this report, just in terms of how we're gauging Intel against some of its competitors out there, which has been losing ground to over the last several quarters?
Sorry about that. I think the key things for Intel are gross margins. So are they able to improve their gross margins from the lows we saw recently? And then what does their server growth trajectory look like? I think they're going to give us a good PC number. I think when they were talking about things getting better earlier this quarter and coming in at the top half of guidance, that really was PCs that are going to fuel the strength this quarter.
When you think about where Intel has been, I mean, I guess part of the argument is that it has gone to such lows. You know, there's only upside to look at, but we're still talking about a company that is in heavy investment mode in terms of expanding, onshoring production. I mean, how do you think investors should be looking at that in relation to the growth opportunities that currently exist?
Yeah, so I think where Intel struggled the last 4 or 5 years has really been on that execution side of things. So it's not that they weren't driving in the right directions. It's that they were struggling to get their manufacturing process in a good place. Unfortunately, I don't think we'll have a clear understanding of where that is following this quarter. But if they can execute on manufacturing, then it brings their costs down. It makes it easier for them to drive into some of these new areas like AI, where just they aren't there yet.
All right, Matt, we're getting the numbers right now, and here's what we've got so far. The company's third quarter adjusted revenue outlook coming in just a bit light. They see $12.9 billion to $13.9 billion. The estimate out there was for $13.28 billion. They also see third quarter EPS of 20 cents. The estimate was for 13 cents, so that at least is slightly better than expected for its second quarter revenue. That beating the street's estimates at $12.9 billion. The estimate was for $12.02 billion. We look at adjusted EPS of 13 cents. That's coming in better than expected here for the second quarter. So second quarter looks like that beat the street's estimates here on both the top and bottom line. Intel also saying that they expect a modest second half recovery. I know you're just getting these numbers as well, but Matt, what's your first takeaway from those numbers?
So, I mean, again, certainly, I think when you look at, in particular, the compute number, it looks like that client computing group number came in better than expected. Again, I think that's what was driving strength for them in Q2. When you talk about Q3 being a bit light, I think where the Intel management team really wants to be is in a place where they can give us a guide and come in and beat that guide, which has been a struggle for this company. So I think giving a little bit lower estimate isn't a bad thing. And obviously the stock reacting nicely to the results.
Yeah, a near 8% pop there for shares of Intel on the back of these latest quarterly results coming in. You were talking earlier about where Intel is. I mean, we're coming off of a quarter where they had the largest quarterly loss. In the previous one, PC sales, as you pointed out, really in decline and a big pain point for Intel. Do the numbers we got today suggest that that's starting to kind of moderate?
Well, I think that what we got today tells us that at least we've seen a bottom, particularly in that PC category. So it's not so much that PC sales are getting better moving forward, but I think certainly Q1 was the low. We worked some inventory out, and now you're starting to see the benefit of that in Q2. And I think for Intel, given their strong share in that space, it's a nice cash generator that they can use in part to allow them to invest in some other interesting areas. And so, yeah, I think it's normalizing. I think it's a good thing.
What are those areas that they will be investing in that could really be a catalyst here for Intel moving forward?
So I think that Intel needs to improve where its execution is in the server CPU space. So that's, again, it's a category where historically they've been dominant. You've seen AMD taking share. You heard Lisa Su talking about higher share in Q2, or their expectation that they will have higher share in Q2. So I think their servers are going to be higher growth than PCs. But then also when you're thinking about new opportunities like AI, I think Intel's been a bit slower to execute in that category. Certainly everyone, to a large extent, is lagging NVIDIA. But if you're able to generate some cash, you're able to get your manufacturing in a better place. If you are doing the manufacturing in-house and you're doing it well, you inherently have a cost advantage. And so that allows you to do some things in terms of pricing, in terms of entering new markets. And so I think that's what Intel's striving, where Intel's striving to be.
Matt, when you think about the semiconductor sector broadly, we have seen heavy subsidies coming through. Obviously, the U.S. really putting out those incentives, Intel taking advantage of them to increase domestic manufacturing. We've seen that happen in Europe as well as China. We got those comments more recently from Commerce Secretary Gina Raimondo, who said that there's going to be a glut of chips, specifically legacy chips, because, well, at least as she said it, of the aggressive subsidies coming through from China. How does that global picture look like for you? And what does that ultimately mean for Intel? Because that has been some of the concerns, the heavy investments going in. Is there a demand waiting on the other end?
So I think that right now we are seeing a glut, and it's not so much supply as it is demand. So I think what happened in 2021 and 2022 is we certainly did see some spikes in some markets that weren't necessarily sustainable. But at the same time, I think the biggest driver in terms of increased demand for semiconductors was the shift to 5G. And so that's a tech shift. That's not turning back. Now, certainly the sharp decline in handsets, particularly Chinese handsets, was unexpected. But I don't see that as something that's sustainable. I think Chinese handsets will pick up. And on the other side of this kind of macro pressure, I think you have a number of kind of mega trends that are just going to drive more semiconductor demand. And so you've got AI, but beyond AI, you've got EVs and ADAS on the automotive side of things. So both of those drive significant increase in consumption of semis for automotive. You've got AR, VR, if Apple's successful in those efforts. You've got IoT, where you need to create more information for the AI in your data centers. You look at your home or my home. I've got my sprinkler systems run by Rachio that has semiconductor content, and I've got so many Rokus. All those have semiconductor content in it. My washing machine annoys the heck out of my wife because it tells me because it tells us both when it's done with the load. But all of this intelligent device, all these more intelligent devices, adding AI at the edge, that all drives semiconductor content. And so I think when we get a macro recovery, there is going to be significant demand for semiconductor content. I also think that a lot of companies are working China out of a portion of their supply chain to diversify risk. So I don't see a glut from China as necessarily the problem. Rather, I think we get a few years out and just these mega trends are going to drive demand. It's just who can execute around getting good products out, around getting them out at good cost through good manufacturing. And it's that manufacturing side that I think we just need to figure out with Intel.
Yeah, it has been fascinating to see the shifts globally, at least that's happening in semiconductors, and the alliances we're starting to see form in that space. Matt Bryson, Wedbush Securities SVP Equity Research. Good to talk to you today.
Thanks.
Coming up, we keep trucking on with earnings and check in on the auto sector as Ford's second quarter earnings results are just crossing. We'll break down the numbers on the other side. Welcome back to Yahoo Finance Live. We are watching shares of Ford and after hours here up nearly 2% on the back of their latest quarterly results. Looking at the numbers right now, revenue increasing 12% year on year to $45 billion. Net income coming in at $1.9 billion. Adjusted EBITDA also higher. Cash and liquidity also coming in strong. I'm looking through the release here, Shauna, and of course the big focus is going to be on what's happening with their EV segment. The Ford Model E revenue up here, looking at 39%. Looking at through those numbers right now, but we're seeing the stock up in a big way, partly because of their guidance.
Yeah, their guidance was strong here. The EPS beat overall coming in at 72 cents. Estimate in the street was for 54 cents. When it comes to the Model E revenue for the second quarter, that though did come in a bit light with revenue there 1.8 billion. The street was looking for 2.07 billion, but it looks like the street really focusing on the full year guidance after the beat that they did just post here. And what that says really in terms of demand, there was lots of questions going into this report about what that demand picture is going to look like. We know that Ford recently cut the price of its F-150 Lightning, which people took as a sign that maybe the demand simply was not living up to that hype. When we talk about Ford pushing into the EV space, trying to do all they can to expand their market share within that, become more of a competitor here to Tesla, which is by far the leader within the EV space. But Ford, at least for these results and the quick reaction from the street, we're looking at shares up almost 2% in extended trading.
Yeah, beating expectations on strong demand for gas-powered vehicles. But the question is going to be how much of that demand can be pushed over to the EV side of things. You were talking about some of the price cuts that we have seen. We've also seen Ford really try to expand a sort of their network here. The charging network, at least most recently with Tesla. You know, so much of this is about a company in transition, trying to address concerns that are out there that have hindered some of the adoption issues on EVs. And it'll be interesting to hear what that commentary is like, because we keep hearing, 2024 is going to be a big one when you think about all the competitors out there that are going to be releasing even more models too. So it'll be interesting to see some of the comments coming through on that front.
Yeah, it certainly will be. And there was a lot of pressure on Ford going into this release after GM earlier this week raised their yearly guidance. So the fact that we did get a raise here, boosting its full year adjusted EBITDA forecast and also posting that beat here. That's a big reason why we're looking at shares trending to the upside here. But again, a lot of focus is going to be on this earnings call, what we're going to hear from Jim Farley in terms of their strategy going forward and how exactly the second half of the year looks, but also looking ahead, like you were saying, into 2024, 2025, and that EV adoption, whether or not they're able to attain some of those lofty goals that they've laid out for the next couple of years.
Yeah, let's bring in Tom Narayan, RBC Capital Markets lead equity analyst for Global Autos. Looking at some of the comments coming through here, Jim Farley saying that the shift to this digital experiences breakthrough EV is underway, but it's going to be volatile. And it certainly has been, whether we're talking about cuts that have come through, where the company has said we need a new skill set, looking at the company trying to compete in increasingly crowded space when it comes to EVs. What stood out to you in the numbers that we got so far?
Yeah, I mean, really, when I look at Ford's results, I really compare it to what happened at GM, right? Everybody's focused on, like you pointed out, the 2023 number, and everybody cares about is the EBIT number. They raised that from 9 to 11 billion to 10 to 12 billion. So pretty decent raise in that. Now, with that, the consensus analysts like me were already at like 10.8 billion. So really, it only goes up by maybe about 400 million, but that's still positive news. Now, what we saw from GM is that stock actually sold off, even though they raised numbers. So it'd be interesting to see, like you said, what they say on the call. If you dig into the numbers, definitely good margins out of especially the Blue segment and Pro especially. The EV segment, though, did post lower margins than the consensus expected. But Jim Farley pointed out in the last quarter's call and in other interviews that this is going to be a segment that's going to take a while for costs to come down. I think they said contribution margin break even by year end, and then maybe margin accretive at the end of 2024. So everything here seems to be consistent with what the company wants and has said. The only issue is were expectations coming into the print already, including all this. You said the stock's up 2% after hours. So maybe there is some more upside here.
Tom, how are you looking at just the slowing EV sales growth? Because within this release, you mentioned the fact that Ford Model E's first-generation electric vehicles revenue there, it did increase 39% in the second quarter sequentially. Revenue more than doubled, but Farley did point out, Jim Farley, CEO there, pointing out the near-term pace of EV adoption will be a little slower than expected. He's framing it that that's actually going to benefit some of the first movers within this space, like Ford. Do you agree with that?
Oh, yeah. I mean, also, you look at where Ford really is, right? Ford's powerhouse is pro. It's more North American exposed. It's less internationally exposed. So EV adoption in North America is probably slower than it is, right, for Europe or China. So if EV adoption is slow, it probably benefits a company like Ford. That's more North America exposed. But, in the long run, though, 24, 25, I do see EV adoption pick up. So it's something that they're going to have to find an answer for eventually.
Tom, what does this stock ultimately trade on? I mean, everything you've said is that when it comes to EVs, as with many other companies, this is a transition. It's a process. You look at the broader market, we're still at 5% of the car market. So is it ultimately valued off of what they're generating on their gas-powered cars? And how should investors be looking at the EV side of things, given the heavy investments that need to go in first in order for the returns to come?
Yeah, I think you have to look at Ford in different parts, right? You have to look at the blue segment, which is its ICE business, its pro segment, which is its best business, and then this EV business, you have to kind of look at it differently, maybe value it on a multiple of sales, right? Because it's so forward-looking. So when you separate these businesses and add them together is kind of, I think, how we think you should be looking at this business. But ultimately, I think investors, when they look at this whole group, are really focused on two things. One is the strike potentially coming up in September. And I do think that could weigh on shares, as it did on GM. The second thing is people are going to be looking at pricing, right? Pricing is at all-time highs across the group. You see it in these numbers. There's a downshift that's included and implied in this guidance in H2. We also heard that from other companies. Volkswagen reported this morning, said the same thing. GM said the same thing. So H2 downshift coming as pricing comes down. So a lot of folks are definitely concerned about if pricing falls, have we already had peak earnings? And then, like I said before, the strike potential impact on that is a big topic.
Yeah, Tom, what do you think that potential impact could look like here? Because at least from the UAW side, they're not backing down. The president there is saying that a strike is very much a potential outcome if their needs or their wants are not met. So what does that mean then for Ford?
Yeah, I mean, this is really why I think a lot of folks didn't buy into what happened with GM's big beat, is they were thinking, should I just wait maybe until we find out what happens with the strike? If you remember in 2019, GM took a hit of $3.6 billion on EBIT. That is huge. Now, people are thinking maybe there'll be some strike fatigue at GM and maybe they'll come out okay this time around. Ford, from what we're hearing, has good relations with the union, so maybe they won't do as badly. And as we've heard, Stellantis may be the one that could get hit this time around. But it's anybody's guess. But ultimately, if what we saw from 2019, if that does happen again, I mean, all of these guys could get hit pretty hard. And it's a question of whether or not investors look past it and just say this is a one-time thing, or do they wait until we see what happens before getting involved in these names?
Yeah, it's a huge cloud hanging over a lot of these car makers right now with those negotiations ongoing. Tom Narayan, it's good to talk to you today. Really appreciate the time.
All right, let's do a check of the market sponsored by Tasty Trade. All three major averages ending the day in the red. You're looking at the Dow off 237 points, snapping that 13-day winning streak. S&P closing off just about 0.6%. Taking a look inside the Dow, worst performer of the day was Honeywell. Honeywell closing off just over 5.5%. And also, when you take a look at some of the action that we saw in yields in the bond market, 10-year yields closing up just around 4%. All right, coming up, we are going around the horn and checking in on some of today's top trending stories. Ali Canal, Josh Schaefer standing by with What's on Tap. Hey, guys.
Hey, Shauna. Well, it's been a buzzkill for some beer makers out there, but not all of them.
We've got some good news to bring you after the break. Grab a frosted glass and dig into it with us.
Because we know that extreme heat can damage crops, it can make people sick, it can make infrastructure buckle and have all these compounding risks, that when heat waves get more intense, economic growth goes down, and this can have compounding economic consequences to the tune of multiple % of GDP per capita over time.
There is a tremendous opportunity to invest in the green transition globally. I think historically we've mistakenly seen this as a trade-off between, do we protect the environment or do we continue to prioritize the economy? There are huge economic opportunities for people who want to invest in the green transition.
Water scarcity is one of the most glaring consequences of the climate crisis. So desalination is a vital aspect of what we call climate adaptation. Desalination means taking water from the ocean, removing the salt, and the result is potable water suitable for drinking, cooking, everything else.
The amount of money that people are spending on utilities in a large swath of the country is enormous, and that money has to come from somewhere. If you have a fixed budget and you're spending more of it to just keep the house cool to survive, that money's not going to be spent on other things.
Those excessive heat warnings, the air quality warnings as well, that is giving AC stocks a boost as businesses try and consume less energy. They are upgrading to newer units. And then you also have the tailwind of the Inflation Reduction Act for individuals, for businesses, if they get new heat pumps, if they get new air conditioning units, etc. So that's what you're seeing with this momentum with these stocks.
Welcome back to Yahoo Finance. Josh Schaefer here with Alexandra Canal and Shauna Smith. We're talking about some of our favorite trending stories of the day. And guys, I want to start with a breaking story that we've been following right now. Sam Adams, Boston Beer, out with earnings right now. And they actually beat on the top and bottom line. So Boston Beer's earnings just coming out right now. Earnings per share came in at $4.07. That's above estimates of $3.35. And then they had revenue of $603 million for the quarter, above estimates of $590 million, $592 million. So a little bit better than expected. I think the stock was popping in after hours trading on that news. I think it's interesting overall to think about what we might hear on this call, though, when we think about the beer space. We've talked a lot about Bud Light sales declining, in some sense, market share being a little bit up for grabs right now in the beer space and who's able to get some of it. I don't know. Sam Adams, obviously, Boston Beer doesn't necessarily make a Sam Adams light that kind of equates to Bud Light, right? But maybe they are seeing some people move over to some of their products in this open space.
Yeah, certainly you would think that this is an opportunity really for anyone within the space, given the backlash that Bud Light, that Anheuser-Busch has faced over the last several months, and that boycott lasting much longer than I think really most people have predicted up until this point. So yes, that could be a near-term, maybe a little bit boost here for Sam Adams, for Boston Beer. But when it comes to the longer-term issues, the fact that people simply are not drinking as much beer as they had been in prior years, we have looked at all of the statistics on a year-over-year basis. We're seeing less and less people opt for beer, and instead they're choosing liquor, they're choosing wine. Clearly, that is an industry headwind that I don't think anyone has really figured out exactly how to solve. Yes, they are pushing into the seltzer business. Yes, they are pushing into some of the ready-to-drink categories that have been selling a little bit better. But I think with companies that are so reliant on beer sales, like a Sam Adams, like a Boston Beer. I always want to call it Sam Adams, like Boston Beer.
As
that
someone
is
from
a
Boston,
huge issue.
I want to call it Sam Adams too.
No, but it's a huge issue, and it's something that's going to be, you would think, keeping back these stocks at least until we see a little bit more, I guess, push and success in some of the other fronts.
You're seeing it on the corporate side too, right? Highlighting today that Anheuser-Busch laying off almost 2% of their work, or less than 2% of their workforce, but still a significant amount of people that they are actually laying off in the wake of what we're seeing with the sales declining. So they're also basically looking at their business and trying to find a way to adjust too, right? Because when you think about Anheuser-Busch, to your point, Shauna, what do you think about? You really think about beer, right? That's the main thing that they're selling. They are also getting into seltzers, getting into ready-to-drink cocktails and things like that. But realistically, you're thinking about beer, and so they're thinking about new ways to structure their business and think about profits as well, and sort of get to a better spot there.
And the Boston Beer Company, it's crazy to see how high the stock is right now in after hours, because I think the expectation was set so low for all of these beer makers. I mean, look, it's almost up nearly 10% in after hours, which we haven't seen from a lot of companies like in the beer space, considering the slowdown that we're seeing overall. I'm curious how Truly Hard Seltzer is performing. Truly has been one of the the underperformers here. Yeah, I was like, which one is that? Underperformers here when we think about that category and all the competition within that category.
It's a good point too when you just think overall, you just pointed to that stock move. Revenue is still down from last year, right? Still worth highlighting that revenue is still down from last year, so it's not exactly like they're growing here. They're just maybe not doing quite as bad as we might have thought.
And they maintain their outlook, right? They didn't cut guidance or outlook, which I think is important too for investors.
Yeah, certainly. And given the environment, given the fact that there's still consumers pulling back on their spending, I think that was enough, at least for the street. Now, all right, guys, one of the trending tickers that I am watching is Crocs. And we talked about this all the time, but when you take a look at the huge move that we saw in the stock today, it might catch you by surprise. And well, in extended hours is moving to the upside, but on an intraday basis, we were looking at a pretty big loss of about 14%. And here's why. Hey Dudes, the company that they acquired not too long ago, it didn't live up to the hype, at least for this quarter. Wholesale revenue was off about 8% on a year-over-year basis. And Hey Dudes, those questions dominated the earnings call. I was going through the transcript time and time again. The CEO there, Andrew Reese, was asked about Hey Dudes, the performance there. And he really pointed to the fact that one, it was weakness in the wholesale business, weakness just in terms of what maybe those wholesalers are expecting when it comes to consumer spending and what people are spending on. But I think it really shows how reliant Crocs is on the success of Hey Dudes to really keep some of that momentum going.
It's the growth story, right? It's your growth metric. And all of these companies, when you think about what's the stock going to do, you want to know what their growth metric is, right? What is it that people actually care about that is going to make the business make more money in 5 years than it's making today?
What's the next thing?
Crocs went out and got Hey Dudes for that reason, because everyone already has Crocs, right? There's only so many Crocs you can buy. You need a new product. They went out and got Hey Dudes, but I think Hey Dudes is also kind of a similar product to Crocs in some ways, right? In the fact that how many Hey Dudes are you
one-trick pony? Yeah.
How many Hey Dudes are you gonna buy? They're good, cheap shoes. They're very comfortable, but the overall outlook for all of us wearing Hey Dudes all the time, you're not gonna wear them to the office. You know, there's just only certain places that you wear them.
Yes.
And as Shauna pointed to, my final point here, people are just spending less. It's not a very good wholesale retail environment right now for products in general. So to expect Hey Dudes to continue to just have meteoric growth is a little bit of a tough expectation, I think.
Yeah, I own 2 pairs of Hey Dudes.
Are you gonna buy a third?
I don't think I would buy a
My
third,
point.
which I was thinking about in terms of the consumer spend story. But also, you know, in terms of those wholesalers, they don't have a lot of confidence in the back half of the year that Hey Dudes is going to sell, which is interesting because in the back half of the year, we have a lot of holidays coming up. We have Christmas. People aren't necessarily buying Hey Dudes for their significant others, for their kids.
I feel like it's beachwear, right?
It is beachwear for sure.
That's how I see them.
Doesn't live up to the hype, though. I feel like everyone talks about how comfortable they are.
They're comfortable,
Worth it?
but they're not long lasting, I would say. I can't
that's not a ringing
walk
endorsement.
a long time in Hey Dudes.
Dude, comfy.
I mean,
Really
why didn't you
comfy.
guys wear, you guys got to keep your extra pairs at the office.
Yeah.
I know.
Well, now I'll have my
I
office
have them
pair of Hey
in my
Dudes.
apartment.
You know, I am the biggest fan of Crocs after becoming a mom. It is my favorite shoe for my kids to wear. It's so easy.
Gotta
They're
go sport
waterproof. I haven't bought myself one yet, but I get why they became popular once again during the pandemic.
I've been noticing that the kids and Gen Z
love them.
Those Gen Z
And Hey
kids,
Dudes.
they love stuff like that.
You got a first-hand experience there, right there. But speaking of, Gen Z, what people are watching, what consumers are gravitating towards, one story that I've been following is the role of sports, particularly the role of sports in the media landscape and with Disney. We've heard from CEO Bob Iger. He's been very adamant that they will take ESPN fully over the top as a streaming service. He said that they are exploring strategic partnerships. There is a report that the NFL, some other major leagues are currently having talks with Disney to potentially partner with them. So I've been digging into this. I've been speaking with a lot of analysts, a lot of experts in this space, and they basically told me that this is going to be a very difficult endeavor. We heard from Comcast CEO earlier this morning saying that it's pretty improbable that they will ever partner with Disney and ESPN. So who could it be? Some names that have been thrown out there. Apple. We know Bob Iger has a very strong symbiotic relationship with Apple. We have the Vision Pro headset that could potentially feed into that. We have Apple with MLS Soccer and Lionel Messi. Maybe that's a strategic partner, or it could be any of the big internet companies. But I think a big question is, who will that be for Disney? It perhaps isn't just one partner, it's perhaps multiple.
It's probably multiple partners, you would think, right? Depending on how big, I guess, the player is. But even if it's Apple, I mean, I don't know if Apple necessarily wants to just be the money bag for ESPN to go out and get sports rights. When we think about how expensive these sports rights are going to be, if that NBA deal is maybe $75 billion, there's a reason Disney doesn't want to foot that bill. And normally in business, $75 billion deals don't just get done with one other partner either, right? There's a lot of banks and different people that could get involved there, maybe even private equity or something like that could also get involved with ESPN to sort of boost that. I think the concept, though, of the NFL investing is very fascinating to me, because or the NBA or one of these leagues investing
How
in
likely
ESPN,
do you think that is?
I think the NFL, it seems less likely when you look at the NFL's media strategy, right? The NFL is one of the most diversified leagues. The NFL is, first of all, it's its own business, right? It's its own major corporation, but also they're across all the streamers. They're on Amazon, they're on YouTube now. They're on Fox, they're on CBS, they're on NBC. That's a very deliberate thing by the NFL, right? They could be on one streamer if they wanted to and get a lot of money for it. But instead they get more money by diversifying that way. But I do think leagues in general have an interest in creating their own content and having a place to bank that content. So you think like the NBA, to get people to be more super fans and watch 5 games instead of 1, that makes sense.
But doesn't the NFL essentially have that with the NFL network? I mean, the ability to do that, to really build out what they want for the league, the voice, everything like that, that they would already kind of, like, I guess, what would that added benefit be?
For them to be invested in ESPN? I don't know. I don't know if I have a full answer there, because I think because I don't think you want to tie yourself to one thing, which is why I would say you wouldn't put it on something like the NFL Network or put it on ESPN, right? Because the NFL is too big. The NFL is Americana at this point. They won that battle. So, like, I wouldn't go narrow.
Yeah, and another story, too, is just when you have free-to-air sports, it's so easy to get this mass audience and this mass appeal. When you ask people to pay $20 to $30 for one thing, that's a harder ask. And that, I think, is something that analysts on Wall Street are grappling with, and the future is unknown.
And I also think, just given the fact that there is so much uncertainty about who would even have interest, who would be willing to pay, that really just shows the pressure that Bob Iger is under right now. How he kind of has his back up against the wall in terms of what he needs to do. And essentially almost every single part of Disney's business, even looking out beyond ESPN, when we talk about the broader streaming strategy, when we talk about the parks business, every single part of the business needs a revamp or needs some sort of, I guess, reshaping at this point. And given the fact that no one really knows who ESPN's partner will be, it's going to be an interesting story to follow. And Allie's going to be all over that one.
Yes, I will. Disney earnings are coming up. 2 weeks.
Just about 2 weeks?
Yeah.
And we'll see whether or not we get any more info from Iger on that call. All right, guys, we got to leave that there. Coming up, we got lots more for you right here on Yahoo Finance.
A recent BlackRock survey finds a record number of Americans are increasingly feeling off track when it comes to retirement savings. Market volatility and inflation are only adding to the anxiety. The country's largest pension fund, California Public Employees Retirement System, or CalPERS, still managed to post a gain of near 6% on the year despite that. I spoke to CEO Marcy Frost about the challenges of investing in this environment and why she continues to double down on ESG.
You're correct. We have a return target of 6.8, and the 5.8 certainly didn't hit that target. So what we're really looking at is we run a very diversified portfolio where we saw the asset classes perform very well. We're in public equity and in private debt, private credit, and the asset classes that did not perform as well would be the private equity and real estate. But I think, where we're looking is, where can we take more active positions, whether that's public equity or private equity? Where can we take the active position where we actually have conviction around a specific strategy or about a trend? And under our new chief investment officer, or newer, I should say, Nicole Musico, adding in those active strategies across the portfolio, that's one of the places where we think we can generate additional alpha.
You mentioned private equity. This was the first full fiscal year where you really ramped up investments in that space, and we did see a bit of a pullback on that, slipped about 2%. Are you rethinking that investment in terms of how prominently it is in the portfolio?
We always look at the way that the assets are allocated across the various markets. We have an agenda item coming up in November, what we call our mid-asset class review, or our mid-asset liability review. So we're always looking to see if the policy targets still make sense under long-term conditions. Remember, we're a very long-term investor. We don't really make dramatic shifts shorter term. But private equity for us, we were a little bit later to the game there. We had a very strong outing, I would say, as private equity was starting to emerge as an asset class back in the 80s. And then we really stalled out over a period of time. We did a 15-year look back of that stall period and really what that cost the portfolio in terms of returns. So I think the secret for us is to stay committed, stay into our policy target that moved from 8% to 13%, and then just making sure that we do that consistent deployment of capital across all of the vintage years. And again, that 15-year look back gave us a bit of insight into areas where we didn't perform as well, and a lot of that can be attributed to the fact that we were not a consistent allocator. So consistency at a time where valuations are coming down, putting capital in while the valuations are lower is still a good strategy. Increasing the allocation to co-investments, starting to look more at venture capital. I know that we have a newer head of our private equity team, and he believes that we've got the team in place, the utility in place to really take the 10% private equity allocation and move that into venture, 10% of that 13%.
What about bonds? I mean, we have seen, you are the largest public pension fund, but we have seen some of your other counterparts talk about increasing exposure when you're getting yields of 5 to 4%, and we have seen so much choppiness, at least in the equity space. Is that something that you're looking to lean in on further?
I think the diversification of the portfolio, the ratio between our equity exposure and the bond exposure, I don't see that changing dramatically. It's been fixed income was a flat performer for us this last fiscal year. We still have some drawdown risk protection in the portfolio, and that did impact our fixed income returns due to some of the duration decisions that were made. We also have a factor weighted sleeve that underperformed our cap weighted sleeve in public markets. But the board will have an opportunity to look at that again in November. One, determine whether that drawdown risk protection is still working the way that we intended it to work, but also look at the allocations to the various asset classes and make sure that they, will, be consistent over the new capital market assumptions that we're starting to see come in.
Let's talk specifically about ESG investments, which is something that you have really been a big proponent of before. Increasingly political, we have seen Republicans recently holding a hearing about the value of ESG investing. You recently doubled down on that, saying that you still believe in exposure, at least on the ESG side. What's driving that? And are you still getting the same returns?
So we're very long-term investors, and the way that we have looked at the E, the S, or the G is really the risk mitigation. So are we being compensated appropriately for every unit of risk that we're taking, whether that's related to climate, whether that's related to human capital, the way that workers are being treated in companies, as an example, or governance? Do we have independent board directors on the companies where we're investing? So our position and our posture on ESG really has not changed, regardless of the political headwinds that are starting to pick up, as we all have noticed. But we are finding great investments on the alternative, more the cleaner energy side in the private part of our portfolio, but we still remain completely invested in the oil and gas industry on the public equity side.
So let's talk about that, because the state of California, the Senate at least recently passed a bill that essentially calls for public pension funds such as yourself to divest from fossil fuel companies. You spoke out against that, saying that that's not necessarily something that CalPERS should be thinking about, especially because your core mission is to maximize returns.
It is.
Is there a bit of a hypocrisy here between doubling down on ESG investments, but also still saying that you don't believe in divesting from fossil fuels? Help me understand that divide.
Yeah, we don't see it as hypocrisy by any means. What we see it as I mentioned, is finding those opportunities where we think we can hit that 6.8 return target that we have in order to pay the benefits to the 2 million members who are expecting to receive them. But also really understanding, as a part of the energy transition itself, how are the current oil and gas companies planning to transition their business models into those cleaner energy technologies? And we have to have a seat at the table. We think that our voice really matters in this. We get the call back when we make a call out to one of the oil and gas CEOs. I get a call back if I need one. But we think that staying in at this point and really understanding the transition, because this is about reducing emissions in the total economy, not just about reducing emissions in a specific sector or specific industry. The moment we start, kind of hammering out a particular part of the portfolio, we do have, this opportunity where we may have missed some returns that we would have otherwise gotten. So we have to be very careful there, very cautious. We have a fiduciary duty, a fiduciary responsibility. So we think staying in for now makes sense, really looking at the energy transition, helping to fund the energy transition, which will take, over $1 trillion of capital to do that appropriately and really not leave anyone behind. And then also finding those great investment deals on the private side of the portfolio, of which we found a number of those. I can't remember the number right now, but I think 30% of the real assets portfolio is already invested in cleaner energy technologies.
If it is about maximizing returns, though, help me understand how big of a hit you would take if you were forced to divest from fossil fuels completely.
Mm-hmm. The numbers that we've been communicating to a variety of stakeholders is that even with a 4.4 potential bips loss in performance, that is about $385 million a year. And over a 20-year period of time, you're talking, over $1 billion, of which those costs get completely transferred to the public employers who are paying into the system. So the unfunded liability is what happens when we expect an investment to return. Remember, we're a universal owner. We own the market, including oil and gas. When we create tracking error by divesting from a particular sector or a particular company, that is tracked on an annual basis by the board's external consultant. And in this case, our assumptions based on economic scenarios is there could be a 4.4 bips loss in return over a 20-year period of time.
And that was CalPERS CEO Marcy Frost. Well, coming up, it is closing time here on Yahoo Finance. We're going to recap the top stories of the day and get you set up for everything you need to know tomorrow. Stay tuned.
Let's take a look at some of the stocks that are trending after hours. First up, Intel. Intel moving up just about 5.5% in extended trading. A strong report here from the company. Upbeat revenue forecast. That's driving the action that we're seeing in extended trading. It's also a sign that demand is improving here for Intel. It also sees third quarter sales of up to $13.9 billion at the high end of the range that they gave, also suggesting that maybe Intel has turned a corner. Now, year to date, we're looking at gains of just about 30%. Not bad, but they have underperformed some of their peers. So again, a move of about 5.5% in extended trading. Next up, Sweetgreen. That stock off just over 9% here. Sales coming in weaker than expected for the quarter, but it wasn't all bad news here for Sweetgreen. Their losses did narrow for Q2. They also raised their forecast for restaurant margins. They're still aiming to be profitable by 2024. Same-store sales grew 3%, boosted by some price hikes. Year to date, the stock up just about 80%. We take a look at that max chart. Ever since the company went public, though, we're still looking at losses, pretty significant losses here for the stock. And let's round it out with Mondelez. That stock up just about 2% here in extended trading. This is the snack maker of Oreos, Trident Gum. The list goes on here. Higher prices helping their most recent results. They beat on both the top and bottom lines for the most recent quarter. They also gave a stronger than expected guidance. They raised their guidance for organic revenue growth and also adjusted earnings growth here for the year. They see organic revenue growth of 12%. Year to date, we're looking at gains of just about 8%.
Well, it is closing time here at Yahoo Finance. Here's a look at some of the top stories and big movers of the day. Shares of QuantumScape, a top trending ticker on Yahoo Finance. The company's an electric battery startup that still is not making money. It's still in pre-sales, but the stock soaring nearly 13% on the day. In its second quarter results, the company saying it is working with a prospective automotive customer to launch its batteries. Meantime, gas prices now rising to an 8-month high. The national average for a gallon of regular gas is now at $3.71 a share. In 16 states, prices are up by at least 15 cents in the last week alone. Finally, a new sign of how Barbenheimer is boosting the economy. New Bank of America data shows cardholders increased non-gas spending by 1.9% during the week ending July 22nd. That's compared to a year ago. One area that surged, entertainment. Spending jumped 13.2% from a year ago. Bank of America saying the gains were likely partially driven by the release of much anticipated movies Barbie and, of course, Oppenheimer.
Now time for what to watch on Friday. First on the list is the Fed's preferred inflation gauge, the PCE report. Now sticking with the central banks, the Bank of Japan is rounding out the week of rate decisions, with traders eyeing a potential policy change. As for the U.S. consumer, Friday will give the final read for the month of July on consumer sentiment. Initial July data has shown that the index has rose for 2 consecutive months, up 13% above June's numbers. And shifting on over to earnings, Procter & Gamble to report their quarterly results before the opening bell. With the pace of retail sales growth slowing in June, we will see how the company held up amid a cautious consumer. Also got Exxon earnings on deck after Shell saw profits slump in its latest quarter. Investors will be watching how Exxon fared as energy prices have eased. That does it for us today on Yahoo Finance Live. We'll see you right back here again tomorrow, 3 p.m. Eastern Time. Have a good day.